Welcome to Pride Partners International's monthly webinar. Thank you for joining us today. Pride Partners International is a global partnership of firms and specialists in transfer pricing and financial valuation. The association is the meeting ground for professionals capable of facing a challenging business environment, helping them connect to boost their continuous professional development and enhance their technical and human skills and abilities. This partnership is made up of experts recognized by their trajectory and prestige in the transfer pricing and financial valuation fields. Experts that constantly participate in the exchange of technical information, knowledge development, and implementation of global best practices. When a firm joins the PPI partnership, it increases its scope immediately and exponentially. Business becomes much simpler by accessing training, technology, resource optimization, and new business opportunities, among other benefits. We invite you to learn more about Pride Partners International. Contact our agents and be part of the global elite of transfer pricing and financial valuation consulting. Our transmission will begin shortly. We invite you to participate actively by sending all your questions or comments through the live chat. Again, thank you for watching, and we hope you enjoy the event.
Hi there, I'm Steve Towers. Welcome to this presentation on two current but unrelated international tax developments. The impact of Pillar 2 on MNEs which use hub jurisdictions and the Coca-Cola US transfer pricing case. And I should mention up front that I will be assuming that you have a good working knowledge of the Pillar 2 blueprint report and the US transfer pricing rules. So let's get started. And we'll start with Pillar 2. But before I go directly to hub jurisdictions, I need to deal with an important preliminary issue: the likely interaction between Pillar 2 and the US GILTI regime. There are two issues to consider in regard to the US GILTI regime. Firstly, will it and should it be accepted as a complying IIR? And secondly, assuming it is accepted as a complying IIR, the interaction with other countries' globe rules and with the proposed multilateral convention. I'm sure you've noticed how the OECD always seems reluctant to accuse the US of not being compliant in regard to international tax matters. We've seen this attitude in previous years in regard to topics such as CRS versus FATCA, the treatment of FDII under BEPS Action 5, and the BEPS Action 6 accommodation of the US Limitation on Benefits article to sit alongside the principal purposes test. I call this the US exception. Well, the Pillar 2 blueprint report provides another example of this in regard to GILTI, even though there is a major difference between the globe rules and GILTI, namely the jurisdictional blending approach under globe versus the worldwide blending under GILTI. The report says this: while GILTI results largely, but not completely, in a global blending of foreign income and taxes, in a number of other respects, the globe rules would be more permissive, that is, more taxpayer-friendly, than GILTI. These include the carry forward of losses and excess taxes, a broader definition of covered taxes, and a carve-out based on a broader range of tangible assets and payroll. Furthermore, GILTI applies without threshold limitations and incorporates expense allocation rules in the calculation of foreign tax credits, which can result in effective rates of taxation above the minimum rate. Finally, the GILTI effective rate is currently set at 13.125% and will increase to 16.4% in 2026. Given the pre-existing nature of the GILTI regime and its legislative intent, there are reasons for treating guilty as a qualified income inclusion rule for purposes of the Globe Rules, provided that the coexistence achieves reasonably equivalent effects. This treatment would need to be reviewed if subsequent legislation or regulations in the US would have the effect of materially narrowing the guilty tax base or reducing the legislated rate of tax. In fact, the Biden administration's proposed corporate tax changes would have the opposite effect, in other words, making guilty even less taxpayer-friendly, increasing the effective tax rate on guilty to 21%, abolishing the 10% QBI exemption, and changing to jurisdictional blending. Of course, whether these proposals will ever become legislated depends on a number of issues, but I think we can say with some confidence that under the Biden administration, the guilty regime won't become more taxpayer-friendly. In my view, this means that the writing's on the wall. The inclusive framework will accept guilty as a complying IIR. So, assuming that guilty is accepted as a complying IIR, what will be the interaction with other countries' Globe Rules and with the proposed multilateral convention? Let's assume we have an MNE group with the UPE resident in the US and all members are 100% direct or indirect subsidiaries of the UPE. The Globe Rules would allow the US IIR, in other words guilty, to apply in regard to all subsidiaries. Consequently, the UTPR generally won't apply in any jurisdiction, subject to one exception, which is the situation where the US is itself a low-tax jurisdiction and deductible intragroup payments are made to the UPE and or its US domestic subsidiaries. In that situation, the UTPR can apply in the payer's jurisdiction. In addition, the subject to tax rule can apply in any of the jurisdictions. For example, a covered payment from DECO to ECO could be subject to an STTR withholding tax levied by Jurisdiction D on ECO. That tax should be taken into account in determining the UPE's foreign tax credit under the guilty rules. Now let's assume that the group includes an intermediate holding company, ACO, in which 20% of the equity is owned by a third party. Under the Globe Rules, the existence of such an intermediate holding company switches off the top-down approach if Jurisdiction A has introduced the IIR into its domestic law. If it has, then the IIR will apply to ACO in regard to DECO, and the IIR will not apply to the UPE in regard to DECO. But that raises a challenge with guilty. There's nothing in the guilty regime which switches it off in this type of situation. Presumably, this will require a law change in the US if guilty is to comply with this aspect of the Globe Rules. Now let's consider the situation where the UPE is resident in another country, Jurisdiction P, but there's a constituent entity resident in the US, which is an intermediate holding company in the group. Initially assume that all shareholdings are 100%. If Jurisdiction P has introduced the IIR into its domestic law, then the top-down approach under the Globe Rules requires that P's IIR is applied and that the IIR in the US, in other words guilty, is not applied. Again, there's nothing in the guilty regime which switches it off in this type of situation. So this will also require a law change in the US if guilty is to comply with this aspect of the Globe Rules. And now let's assume that the US intermediate holding company is partially owned, with 20% of its equity owned by a third party. As you know, in this situation, the top-down approach under the Globe Rules is switched off, which means that P's IIR does not apply to the UPE in regard to the US company subsidiaries, and instead the US IIR, in other words GILTI, will apply to the US company in regard to its subsidiaries. So this situation does not require a US law change. If GILTI is accepted as a complying IIR, there's another issue. Will the US sign and ratify the proposed multilateral convention, which will be intended to maintain global consistency of all the IIR regimes throughout the world? As you know, in the past, the US has shown a reluctance to sign multilateral tax agreements, for example, the BEPS MLI, and has experienced significant difficulty in obtaining Senate approval for ratification of signed treaties. That reluctance to sign multilateral agreements might change under the Biden administration. Now that the Democrats have control of the Senate, it could be a different environment. Of course, another possibility is the US exception. The inclusive framework might accept GILTI as a complying IIR and not require the US to sign the multilateral convention. The Globe Rules and the Subject to Tax Rule might have a significant impact on the world's major hub jurisdictions, such as Ireland and Luxembourg in Europe, and Hong Kong and Singapore in Asia. Let me explain why. A preliminary point I should make is that, of course, we don't know what the minimum tax rates will be for the Globe Rules or for the STTR. However, remember that in regard to the Globe Rules, the minimum rate refers to an effective tax rate, not the nominal rate. So, for example, even if the inclusive framework decides to use 12.5% as the minimum rate for the Globe Rules, which of course equals the nominal rate for trading profits in Ireland, that doesn't mean that the Globe Rules won't impact hubs located in Ireland. It's the ETR which is key. And as you know, the STTR uses an adjusted nominal rate, which might also be quite different from the nominal rate in particular hub jurisdictions. So therefore, all hub jurisdictions, regardless of their nominal rates, are potentially within scope of the Globe Rules and the STTR. The first point to note is that not all businesses will be within scope of the Globe Rules and the STTR. The 750 million euros consolidated global revenue threshold will apply to the Globe Rules, and it's possible that a similar threshold will also apply to the STTR. This will mean that small and medium-sized groups will generally be outside the scope of the rules. Also, it's likely that investment funds and pension funds will be excluded from the scope of the Globe Rules and the STTR, although subgroups controlled by such entities might be within scope. The exclusion of investment funds and pension funds will be relevant to those hub jurisdictions which are major fund management locations, such as Luxembourg and Singapore. Also, the report states that further work will be done on whether the international shipping industry should be excluded from the Globe Rules, which will be particularly relevant to Hong Kong and Singapore. If the minimum tax rate for the Globe Rules is set at 12.5% or lower, then the nominal corporate income tax rate in all four of these hub jurisdictions will be equal to or above the minimum rate. But as already mentioned, it's the effective tax rate which is relevant under Globe. The hub jurisdictions have various factors in their corporate income tax law which can reduce the ETR for certain groups. Those factors can result in the triggering of the Globe Rules. Firstly, there are those factors which can be described as gaps in the corporate income tax base. This can be seen most clearly with Hong Kong and Singapore. Capital gains are exempt in both jurisdictions, and foreign-sourced income is exempt in Hong Kong and taxable on a remittance basis in Singapore. Both of these factors will generally drive the ETR lower, although I should note that with Singapore's remittance basis for foreign-sourced income, Singapore tax will apply when the income is remitted to Singapore, which includes a deemed remittance rule. So this aspect is really a timing difference, which might generate an IIR tax credit and a local tax carry forward. Nevertheless, some of these items will be treated as permanent differences and thus will be excluded from the globe tax base, with no impact on ETR. For example, gains or losses on the disposal of shares other than portfolio holdings, and dividends other than on portfolio holdings. Secondly, there are tax incentives, either in the form of reduced tax rates or reduced taxable base, or sometimes both. These will definitely drive the ETR lower because the amount of covered taxes in the numerator of the ETR formula will be reduced. Other incentives might fall within the category of tax credits, refundable or otherwise, and government grants. These might be treated as reducing the amount of covered taxes in the numerator or increasing the amount of globe tax base in the denominator of the ETR formula. Both treatments will reduce the ETR, but the reduction of covered taxes will generally have a larger impact on the ETR than the same amount of increase in the globe tax base. The STTR can apply even if the jurisdiction's ETR is equal to or higher than the minimum rate for the purposes of the globe rules. This is because the STTR does not look at the constituent entity's total profits, but only considers individual payments. So, for example, if an individual payment falls within one of the gaps in the corporate income tax law of the hub jurisdiction, the STTR can apply, even though the jurisdiction is not classified as low tax under the globe rules. However, the STTR does have major limitations. It can apply only to certain payments, interest, royalties, and other covered payments which are received from connected persons, although the report says that further work will be done on the question of whether the STTR will apply to capital gains without a connected persons requirement. This means that some major activities of hub jurisdictions will not be subject to the STTR. Most obviously, all payments received from third parties will be excluded from the STTR, absent a conduit structure. But also payments for trading income, such as from the sale of goods, even though the income is received from connected persons, are excluded from the STTR. For example, a sale of goods by a principal company resident in a hub jurisdiction to a related distributor in another jurisdiction should be excluded from the STTR, even though the sale price might reflect an embedded royalty for the IP owned by the principal company. There will be some MNE groups with subsidiaries resident in hub jurisdictions which will not be impacted by the globe rules or by the STTR. For example, because the group is not within the scope of the rules, or because the ETR in the jurisdiction satisfies the globe minimum rate, or because the UPE is a US corporation and the US GILTI regime is treated as a complying IIR, or in regard to the STTR because the subsidiaries derive their income from third parties or in a form which is not interest, royalties, or other covered payments. But other groups will likely face a globe tax liability and or an STTR tax liability in regard to the hub jurisdiction. In regard to these groups, what can be done? Firstly, and most obviously, the extra tax liability might not be significant. In that case, just pay it and get on with business. Secondly, see if the activities of the subsidiaries can be changed to avoid the GLOBE or STTR tax liability. For example, the current structure might involve an IP holding company resident in a hub jurisdiction, which licenses IP to a related manufacturer in a source jurisdiction in return for a royalty stream. The royalty stream will be within scope of the STTR if the group itself is within scope of the STTR. One alternative would be for the IP holding company to sell the IP rights for the source jurisdiction to the manufacturer for a capital sum, which would then be depreciated for tax purposes in the source jurisdiction. This will enable a large amount of base erosion to occur in the source jurisdiction in a form to which the STTR rules do not apply. And thirdly, if the GLOBE or STTR tax liability is caused by a tax incentive, then maybe a smaller incentive or even no tax incentive might make some sense, particularly if the governments in the hub jurisdictions compensate the subsidiaries with non-tax incentives, such as government grants, subsidies for rent, utilities or payroll expenses, and so on. However, you should note that such non-tax incentives might cause the GLOBE tax base to increase, which would have a downward effect on the ETR formula, albeit a smaller impact than the equivalent amount of tax incentive. I'll now discuss the US tax court's decision in the Coca-Cola transfer pricing case, a major victory for the IRS. I'll start with an overview of the case and then I'll provide some specific comments. The US company is the owner of all the IP which is necessary to manufacture, distribute and sell a range of well-known beverages. The IP includes trademarks, product names, logos, patents, secret formulas and proprietary manufacturing processes. The group includes several manufacturing subsidiaries in various countries outside the US. These manufacturing subsidiaries are called supply points. The US company licensed the IP to the supply points to manufacture beverage concentrate. The licenses could be terminated by the US company at will without compensation. Also, the licenses conferred no territorial exclusivity. The supply points sold the concentrate to unrelated bottlers, which manufactured the finished beverages for sale to distributors and retailers. During the relevant tax years, the supply points paid royalties to the US company, which was set under a formula which had been agreed between the US company and the IRS when settling a tax audit 10 years earlier. However, that agreement with the IRS was not expressed to have any prospective operation. In regard to the relevant tax years, the IRS claimed that the formula undercompensated the US company for the use of its IP. The IRS therefore made significant transfer pricing adjustments to the US company's taxable profits. The IRS applied the Comparable Profits Method, CPM, using Return on Operating Assets as the profit level indicator. The IRS used the unrelated bottlers as comparable parties. The CPM is the US version of the OECD's TNMM. The US company argued that the relevant US transfer pricing regulations treated the CPM as an inferior method, being a method of last resort. That argument was rejected by the court, who said that the best method rule must be applied based on the available data. The court also held that none of three alternative methods, the comparable uncontrolled transaction method, the residual profit split method, and an asset management method was the best method in this case. In regard to the comparable uncontrolled transaction method, the court held that there were no comparable uncontrolled licenses of the Coca-Cola IP available, and so that method could not be used. The court rejected the use of a residual profit split method for several reasons, including two in particular. Firstly, the supply points were not the legal owners of the IP and did not have substantive contractual rights in regard to the IP. And secondly, the US company's application of this method was solely based on relative consumer advertising expenditure in the relevant tax years, without factoring in the value of the US company's IP. As the court said, consumer advertising is worth little unless the seller has a product that people wish to buy. And the court also rejected the use of an asset management method, which analogized the US company as an asset manager. Asset managers typically do not supply valuable intangibles to the portfolio companies they manage. The court concluded that the comparable profits method was the best method in this case, because only the US company and not the supply points owned the valuable IP, and the supply points had no substantive contractual rights in regard to the IP. The court also concluded that the unrelated bottlers were appropriate comparable parties, and that the return on operating assets was computed using reliable data, assumptions and adjustments. And so the court decided in favour of the IRS. I'll now provide some comments on this case. Firstly, the court refused to accept the company's argument that it could continue to use a pricing formula which had been agreed between the company and the IRS to settle an audit 10 years earlier, despite the fact that the audit closing agreement with the IRS was not expressed to have any prospective operation. According to the court, the short and, we think, the complete answer to petitioner's argument is that the closing agreement says nothing whatever about the transfer pricing methodology that was to apply for years after 1995. For its part, petitioner may have desired the certainty that would arise from indefinite future application of the formula method, but there is no evidence in the document that the IRS shared that desire or agreed to implement it. Secondly, one of the key facts in this case is that the IP was licensed by the US company to the supply points under terms which allowed the US company to terminate the licenses at will, without compensation. Also, the licenses conferred no territorial exclusivity. Therefore, from a contractual viewpoint, the supply points had no substantive rights in the IP. But the company argued that the economic substance painted a different picture. In particular, the significant expenditure incurred by the supply points on consumer advertising. The court rejected that argument for two reasons. Firstly, the transfer pricing regulations provide absolutely no support for the notion that a taxpayer can set aside the unambiguous terms of a related party agreement on the theory that they do not comport with economic substance. In other words, the ability to use economic substance to disregard legal arrangements attaches to the IRS, not to the taxpayer. And secondly, petitioner has cited no authority for the proposition that spending money on consumer advertising without more gives rise to freestanding intangible assets as a matter of economic substance. The third comment concerns the comparable uncontrolled transaction, CUT, method. The company argued that the cut method supported the royalties charged to the supply points. However, the company's analysis was based on master franchising arrangements which are entered into between fast food chains like McDonald's and Domino's and regional franchisees. The court rejected that analysis on the basis that the transactions are not comparable for various reasons. Nor can the supply points plausibly be analogized to master franchisees. The master franchisees appear to have had long-term agreements ranging from 10 to 50 years that endowed them with exclusive rights within a specified territory. The supply points manufactured concentrate. They played no role in managing the franchise, in selecting sub-franchisees, or in overseeing bottlers in any geographic territory. And as manufacturers and distributors, the bottlers cannot be analogized to owners of restaurants that serve consumers. And my final comment concerns a flaw in the company's analysis on three alternative pricing methods: the cut method, the residual profit split method, and the so-called asset management method. For each of those methods, the company's experts performed analysis which did not consider a supply point as a separate legal entity, but instead considered the so-called field, which is the supply point and the related service company in each relevant geography. As the court said in regard to the company's expert on the cut method, in seeking to calculate an arm's length royalty payable to petitioner by the field, Dr. Uni has posited a controlled taxpayer that does not exist. So here are my lessons from this important decision. Don't assume that pricing methods in audit closing agreements can be used in the future if the agreement is silent on that point. The terms of written contracts between related parties matter, and the separation of legal entities, even if they are related, matters as well. And the availability of public evidence of the terms of transactions does not reduce the standard for comparability.
Well, I hope you enjoyed this presentation. I'm Steve Towers. I'll see you next time.